guys, welcome to lesson 3. We're going to be talking about mortgage insurance, which is still a part of your payment. Last lesson, you went over some of the things that are incorporated in the mortgage payment. But this mortgage insurance, title insurance, and homeowners insurance can be a bit tricky for someone who doesn't understand it. What is the clear difference between all three?
Right. All right, so again, I'll start out with title insurance. Title insurance protects, there's two versions of title insurance. There's owner's title insurance and lender's title insurance coverage. Both of them are designed to protect the interest of either the owner or the lender in the event that there was some claim that may arise after you go to settlement that puts a cloud on the title. So generally speaking, what happens is part of the process. Title company sends an abstractor down to the courthouse to search the land records to identify any and all liens that exist on the property. And their job is to make sure all that stuff gets paid off before settlement or at settlement.
Gotcha.
So anything that the seller any obligation the seller might have owed that was a lien against that property should be taken care of at settlement or before settlement. Sometimes, somehow, some things get missed. It's very rare, but sometimes it does get missed. The lender absolutely will never accept being at risk for that. All right. So the lender requires that you purchase lender's title coverage, because what happens is that title insurance will, if there was some type of a claim that came up after the fact that threatened the lender's interest in the property, the title insurance will basically cover that for the lender. The lender will suffer no loss. The owner's coverage protects your interest, your equity in the property, as well as the owner, but it's optional. You don't have to protect yourself, but the lender does make you protect the lender. The lender's coverage is typically a lot more expensive than the owner's coverage because it's covering the lender's whole loan amount interest in the property, whereas the owner's equity is a little bit less typically, and so the owner's coverage is a little bit lower. But again, that's not in the mortgage payment. That's just a one-time fee that you pay at settlement. You make that decision whether or not you want to purchase the owner's coverage. Lender's coverage is mandatory. So that's title insurance. Protects against any type of liens that don't get satisfied at settlement that may pop up after you've purchased the property. Homeowners insurance protects. If the house burns down, you go to the insurance company, they'll cut you a check to rebuild it. If you have some major wind damage, to the property, a tree falls in your house, damages your house, you go to the homeowners insurance company, they fix that. There's a whole lot more that goes into it. You've got a whole class that you've been wanting us to put out there. We're going to put out there eventually with one of our homeowners insurance partners that can go into it a lot more deeply. But simply put, that's the main thing. You've got to have coverage. Lender's going to require it. You want to have it as a homeowner as well, because you want to be protected. You're going to pay, as I said, $600 to a couple $1,000 depending upon the size of the home and the amount of coverage that you have. The lender's going to require that you have enough coverage to rebuild the property, all right, to replace the property. If it were to burn down in a total loss, you've got to be able to replace the property, because our lien, our collateral, the house is our collateral, so we need to know that there's enough coverage to rebuild the property. Right. Then mortgage insurance. That's a trickier one, right? So mortgage insurance protects the lender in the event that you don't pay. If you buy a house for $100,000 and you took out a loan for $95,000 and you get sick, and all of a sudden you can't make your payments a year later, and the mortgage balance is $93,000 a year later. The house, maybe even if it's gone up a little bit, it's worth $102,000. The lender has to foreclose. I hate talking about it, but it's the reality. If the lender forecloses on the property, you've got a $102,000 property, but you owe the lender $93,000. Maybe you've, at this point, because behind on the payments, they're foreclosing. Now you've owed $4,000 or $5,000 worth of payments. So you really owe them about $98,000. They take the property back. There's a cost to pay attorneys and go through. There's a whole process to go through to be able to foreclose on the property. The lender might only get, and then they have to pay a realtor to resell it. They may only get $70,000 net after all of the expenses to reclaim the property, evict you, put it back in the market, pay realtors fees, clean the property out, and all that stuff, and pay sellers fees, buyers fees. They've lost, now the lender's lost $28,000 in this mythical example. Where's that money? How the lender needs to be kind of reimbursed for that.
Right.
So the way that they, that's what mortgage insurance does. Then they go to the mortgage insurance company to be reimbursed for that loss. The reason that mortgage insurance plays a vital role is that it's the only reason lenders will make a loan for $95,000 on a $100,000 property, because they don't want to be in a position where they can lose that much money. Mortgage insurance pays them if they lose that money, so that allows them to make these loans at a higher loan to value, and so the buyer can get in with less money down. So mortgage insurance is vital. It's not a bad thing. It's an important thing to help make home ownership more accessible to many folks. On a conventional loan, the mortgage insurance is provided by private companies. There's a bunch of them, like 6 of them now, that provide that mortgage insurance. And the mortgage insurance premium is, each company has a slightly different rate sheet for their premiums, but they're generally in the same ballpark, but there's a sliding scale that's based upon the borrower's credit and also how much money they put down. There's also some other factors that can go in there, but the main thing is credit score and down payment. So the better your credit score, the lower your mortgage insurance premium. The lower your credit score, the higher that mortgage insurance premium. All right. Now, on an FHA loan, the mortgage insurance premium is the mortgage insurance company is the federal government. It's FHA, Federal Housing Administration.
Right.
So that's why you heard the term PMI on a conventional loan is private mortgage insurance, whereas on an FHA loan it's called MIP, just mortgage insurance premium. It's provided by the government, and it's standard. It doesn't fluctuate based upon your credit score. There's an upfront premium, and it's generally 1.75%, and then there's a monthly premium that is generally 0.8. It's an annual premium that's paid monthly. The annual premium is 0.85% of the loan amount, and that's actually divided out and paid on a monthly basis. So those are the three differences between those three things. The mortgage insurance premium is the one thing that, as a buyer or lender, we can kind of get creative with different strategies. One is not creative; it's just trying to maybe increase your credit score to get a lower mortgage insurance premium. We can also shop the mortgage insurance premium between companies, because sometimes some of them may have enough of it. May still be a $5 or $10 a month difference in the mortgage insurance premium on a conventional loan. On an FHA loan, like I said, there's no negotiation. The government's mortgage insurance premium is what it is. But what we do as part of the analysis for our borrowers is figure out whether or not the FHA loan or the conventional loan is better. If you've got a high credit score, and most of your other factors are in really good shape, 98 times out of 100, conventional loan option is going to be better for you, because the mortgage insurance is going to be lower on a conventional loan than the FHA premium. But if you have a mid-range to low credit score, the FHA mortgage insurance is actually cheaper. Downside to the FHA mortgage insurance is that for most borrowers, if you're just doing the standard down payment for an FHA loan, is the the mortgage insurance premium never goes away. You're going to be paying it throughout the life of the loan, unless you pay a loan off or refinance it. On a conventional loan, that mortgage insurance premium will automatically, by law, go away as soon as you pay your loan balance down to 78% of the original purchase price. All right, you bought the house for $100,000. You start out with a $95,000 loan. As soon as your loan balance hits 78, that extra $50 or whatever it is for the mortgage insurance premium goes away. All right. You have the right to also petition your lender to get rid of that conventional mortgage insurance premium at any time you think that you've got 20% equity in the property. So if your house went up to $110,000 in value, and now you've paid your loan down to $85,000, you've got 20% equity. You can ask the lender to drop it. They're under no obligation to drop it. All right, but they're absolutely obligated to drop it when you pay it down to 78% of the original value. The other thing a lot of folks do is that whether it's an FHA or a conventional mortgage with mortgage insurance, we often have folks that come back after their property value increases in value. We'll come back and do a refinance using the new appraised value to get out of the mortgage insurance.
I got you. Right. So you can be a little bit strategic there in a manner, according to credit score. But so it seems like mortgage insurance is absolutely non-negotiable unless you put 20% down. Correct? Right.
And there are loan programs that'll say no mortgage insurance with less than 20% down. It's a bit of it's kind of marketing, because there is mortgage insurance. The lenders aren't going to do it without the mortgage insurance, but what it is it's self-insured. You're going to be paying a higher interest rate, all right? And they essentially are building the insurance in by charging you a higher interest rate, all right? So there are loan programs with less than 20% down that do not have mortgage insurance. One caveat, we didn't talk about VA loans. If you are a veteran, VA loans do not have mortgage insurance. It's a beautiful thing, right? So you can put no money down on a VA loan and have no mortgage insurance. The only thing that VA does have is they have a one-time upfront VA funding fee that's going to range from 1.65% to 3.6%, depending upon if you're a first-time user or not. But even with that, if you're have a disability, disabled veteran, get any disability benefits, then you don't even have to pay that one-time funding fee.
Yeah. That's all. I mean, listen. Sometimes I look at their benefits and think to myself, like, he's joining, the National Guard or something, right? Last question. Shopping for these services. Which can I shop for title insurance? Can I shop for mortgage insurance? And am I able to also shop for homeowners insurance? And then the second part of that question is, how do I go about figuring out what's the best option for me?
Right. So you can't shop for you can shop for all of it. That's it. All right. You can shop for the title insurance because you have a right to pick whatever title company you want to use. All right. A lot of times buyers will because they don't know who to go with, will go with a recommendation from their realtor or their lender. But you absolutely have the right to shop for title insurance services. Homeowners insurance, we actually rely on you to shop for that. We're not involved in that process as a lender. You go out, and a lot of times we tell folks, start with your car insurance, company. But you absolutely should shop that, as well, because you can get quotes that could vary by $200 or $300. $200 or $300 is $20 a month, or it's $20, potentially $30 a month on the insurance. So you might be able to shop it and end up figuring out a way to bundle, get a good deal between your home and auto, where you can actually get an even greater savings. And in the mortgage insurance, you can't shop that yourself. What you can do is basically make sure that your loan officer, shops it. All right, and that's what we do. We have in our system, when we put the loan in, we basically have a system that will just automatically shop the mortgage insurance on a conventional loan, and we always pick the one that's the cheapest for the borrower.
Because we're normally wrestling with ATI issues.
Right, exactly.
Right, so we're trying to make it work, which makes sense. Hopefully, guys, this is lesson 3, and hopefully you guys were able to look at all 3 of these lessons and kind of get a great understanding of what your mortgage payment will consist of. That way, you can plan for post-closing. You can budget your money a little better. You can start to really frame your future, hopefully, or get a good understanding of how you will frame your future now that we understand what that mortgage payment will consist of. Guys, look forward to the next course, and I will see you on the next live. All right, have a